Okay, so we're going to cover other insured riders, such as spouse term riders, family term riders, other insured riders, and riders that let you change the insured on a policy. So usually these are for term policies. So I'm going to cover the first one here. We'll just pick one of them, the child rider, children's rider. So what this usually does, it usually offers, if someone gets a whole life policy, okay, or a term policy, they can have as a rider on that policy, as an additional feature, they can have term coverage to cover their children. All right, so how it works is just one flat fee for all the children in the family, and if any of the children pass away, then a death benefit is paid out to the family for whichever or however many of the children passed. So say an example, if they're like, okay, well, under the children's rider, if any of your children die, then you're going to get a $10,000 payout for each of the children that pass away. And it's just one flat fee for all of the children on the rider. There's also a family term rider that allows the policy owner to add someone like a spouse. Okay, so usually the policy owner can add their spouse as a term rider on their policy. Now, some of these riders require insurability. Some of them don't. Most of them have some sort of underwriting required for that person to qualify for the rider. But what this does is it lets people get some insurance for cheaper. So if they say like the parents have their own policy, and then they get riders on the children, a children's rider. It's cheaper usually to do that than to get each child their own individual policy, because the risk is spread out between all the children, and I don't know how the insurance companies figure it out, but that's the basics of it. And the same thing with the family rider or the spouse term rider. If you have a spouse who is added as a term rider to the other spouse's policy, usually that term insurance is cheaper than if they went and got their own term insurance. Now, there is a non-family. There's a rider for non-family insureds, and usually this has to do with businesses or corporations, and there are riders that allow them to change the insured. So it's a change insured rider or substitute insured rider. And what this allows is, say you have a company that takes out a policy on one of its employees, because they say, hey, if this person dies, we want to be able to pay for someone to take their position. We want to be able to pay for any losses we will sustain if this person's not here. And we will want to be able to pay to recruit and find someone and train someone to fill that role. So they could say, okay, well, we're going to get insurance on this person. We want to be able to change that insurance to someone else if that person leaves the company. And that is so the change insured or substitute insured rider is there, and when that's there, that they can change the insured, but the insured usually has to go through some sort of underwriting and show that they have evidence of insurability. So with the other insured riders, the riders that allow people to add other people to their policy, we have the children's rider, which typically is one premium to cover all the children. Now, I know here at our agency, we have a policy that has a children's term rider that each child pays each premium. Every child you add, there's an additional premium. In your course, it may talk about how there are policies where one fee covers all the children. That could be the case, but there are also some where each child pays their own additional premium, or each child doesn't pay their own premium, but the premium increases based on how many children are on that policy and how many children are covered. The spouse term rider covers the spouse. If the spouse passes away, then it'll have a term coverage. Usually the spouse term rider expires by age 65. The children's term rider usually expires by ages 18 or 21. The one that we sell expires at age 25, so the company can change those. And then the other insured riders, the non-family insured riders, the ones that allow the policy owner to change the insured if something should happen, those ones are obviously, and with all the other ones too, there has to be some evidence of insurability when you're changing or adding someone to insurance as a rider. So like usually people have to, if for some of the child ones, and they're not all like this, but most of them, if people add their children, the children can't be like, morbidly obese and diabetic and have high blood pressure and all that stuff. If someone wants to add their spouse, the spouse can't be like on their deathbed about to pass away. Okay, so there is some underwriting on all these, but what these riders allow the owner of the policy to do is add coverage for other people to the policy, which is usually cheaper than if they added that same amount of coverage on a totally separate policy. So I hope this helped you. If you found value in this, subscribe to the channel, turn on post notifications, and then click the link above to learn about every single life insurance policy you'll have to know for your life insurance exam course.